the ECB for the great hospitality for the conference, to the entire organizing team, and in particular to the locals, Katarina and Agnese, and also to Carolina, Fiorella, the BIS, the entire program committee, and also obviously to all of you here, all the speakers and discussants, and to the CPR staff, Petra and Despina. Now, it is my great pleasure to introduce Philip Lane, with member of the Executive Board and Chief Economist of the ECB. Philip's career is so extremely distinguished that I'm not even going to try to list all his achievements. Besides his key role at the ECB, Philip's intervention in the public debate are always very clear and substantial. I read all your speeches. I always find them extremely enlightening. I should also mention that Philip is a CEPR Research Fellow since 2002, and so that's a great achievement. He is an extremely well-cited international macroeconomist. And for example, all of us know his famous paper on the voracity effect with Aaron Turnell. He has also been a very important pioneering contributor in the new open economy macroeconomics with new Keynesian models. He has obviously also extremely influential work on the external wealth of nations with Gian Maria Milesi Ferretti. That has been absolutely path-breaking work in international macroeconomics and finance, and certainly it has greatly inspired my own research. So Philip, I'm delighted to welcome you here on stage.
So let me thank the organizing committee for inviting me. I'm really happy to be able to participate, and I think the program both yesterday and today has been really excellent. I think that poster format at lunch yesterday was really effective. Unfortunately, for some reason, after this speech, I have to go to the executive board and kind of make decisions about the budget and so on for the ECB. So I won't be able to stay here. And let me thank Hélène for the very nice introduction. I think we're of the same generation, so we've kind of, which is very nice as you get older. It's very nice as you get older to have people who've been on the same generational cohort as you and to really explore these topics. In any event, what I want to talk today, because again, this is a macro finance conference, and the topic of how monetary policy transmits is really at the intersection of macro and finance. So what I want to do is really, if you like, uncover the veil behind a lot of the monetary transmission analysis that is done here at the ECB. So let me thank the group of ECB staff who've really put together the analytics I'm going to show. So I'm just the reporter here. The actual work gets done by the ECB staff. The nature of monetary policy is we meet every 6 weeks, which means that a lot of this analysis is basically in a perpetual update. It's a perpetual update because the same models are kind of re-estimated, reassessed every few weeks. So again, for those of you both in central banks and academia who develop analysis, develop models, you may not get cited by us because a lot of that work is confidential, but there really is a kind of exploitation of the intellectual property developed by the macrofinance community. Okay, so now, in any event, and on the ECB website, you can read the full speech, but I'm not going to stand here and read very technical sentences, which might be a bit difficult for you to follow, and also it would take too much time. So what I'm going to do is kind of convey with some of the main charts and so on from the speech. Maybe my download count can go from Hélène. So usually my speeches might get one download. I now know it's Hélène to more than one download, in the online data. So let me just start with a very basic issue. And I'm not so sure the other central banks articulate how to make monetary policy in the same way. But this is a standard paragraph in our monetary policy statement. And if you like, we've decided we're not going to provide forward guidance in the sense of saying, look, all else equal, we think the interest rate the dot plot or the interest rate is going to be X, Y, and Z if conditions are maintained. But what we want to do is to help the outside world try and, if you like, have the ability to, if you like, reverse engineer or shadow what we're doing. And so what we say is, what is the goal? It's 2% in the medium term. It's not 2% every quarter, but in this incredibly precise phrase, the medium term, we want it to be at 2%. We say, in line with what I just said, we're going to not pre-commit. So in every meeting, we're going to look in an integrated way at the data and then make our decision. And you might say, well, tell me the data you're going to look at. And it's going to be the inflation outlook. And I think you can think of that like as the most likely part. What is the base case for inflation? The risks surrounding it. And of course, I think everyone now is elevating emphasis on this issue, which is, okay, maybe that makes sense under the baseline, but are you sure it's robust to any particular list of upside and downside risks? And then a cross-check with the underlying inflation dynamics. And what I want to focus on today is the strength of monetary policy transmission. Now, I don't know how many of you have tried to think about that question. How does monetary policy transmit to the economy? And then you get into a lot of questions. Is this a systematic monetary policy, which is predictably responding to some shock to output or inflation? Or is it a monetary policy surprise, where compared to what the market expected, you've done something surprising? So that most basic anticipated versus unanticipated is there. It very much depends, and maybe I'll come back to this throughout the speech, in terms of if you look beyond the representative agent. And there's a lot of Hank thinking at the ECB, because of course it depends on whether, and behavioral economics as well, it depends on whether people are really forward-looking. So the expectation of an interest rate hike 5 years from now matters for behavior today, versus people who are more heavily discount the future and are more focused on the actual policy decision. It varies a lot across models, and every so often I think the ECB staff publish, here's how much investment moves, consumption moves, inflation moves to 100 basis point shock, depending on the macro model you use. And that idea of model robustness is also very important. So with all of that is you cannot say, I have the perfect model, I read off the monetary policy impact of that model and I'm done. It makes more sense to really understand what's happening in the data, and that's what I want to try and do. So maybe the first step in that sequence is to ask, is monetary policy effective in moving the broader set of financial conditions? I mean, obviously, if you're paying attention to the current developments, there's a big debate in the US about whether the impact of the equity markets, private credit, and so on means that monetary conditions are looser than might be expected from the policy rate. So that's a very basic cross-check, is when we move the interest rate, do we move broader financial conditions? And how do we aggregate financial conditions? It's basically the best predictors of future inflation and output. So it's the elements of financial conditions that predict where output and inflation are going in the future. And that's why it's a macro financial conditions index. So in the left panel there, the orange line is our policy rate, and the blue line is the overall index. And you can look at that in two ways. One is, it looks like there's a strong correlation. So a lot of the time, the policy rate does seem to drive financial conditions, but there are plenty of exceptions. So there are exceptions during the global financial crisis, at the start of COVID, and so on. So what I want to emphasize here is when you think about this index, which is kind of normalized to zero, what we've had now is when we started hiking is a really big change. We went from accommodative to tight very quickly. That's a steep movement, both in the policy rate and in financial conditions. It's unwound but only partially. So the level of the financial index now is still tighter than the historic norm. And that's a really important feature of where we are. Essentially, before the pandemic, financial conditions were priced on low for long. People believed we were in a chronic low inflation environment, requiring basically open-endedly remain at the lower bound as far as the eye can see. What we have now is a resetting. There's an anchoring of inflation expectations at the target. And we have not just the policy rate, but long rates, real rates, all of these have moved. The other point, if you stare closely at the last few data points of that, is there has been an easing from equity markets in the last few months. This is the dark green smudge below the zero line. But it's just, the equity market is just not big enough in Europe. It's not a big predictor of future output. So the contribution of the equity market to financial conditions in Europe is limited. So it's possible simultaneously to be concerned that the scale of kind of market pricing in the US is creating loose financial conditions and not have the same concern in the European data. And then the right chart is just basically saying this new index, is comparable, if not a bit better than some of the other indices. Okay, so that's one cross-check. Is our policy rate correlating with overall financial conditions? The second cross-check is, are we affecting the banking sector? The banking sector remains, super important in a European case. And again, when you get a chance, it might be easier to look at those graphs on the website to look in more detail. But basically here, the staff are looking at different easing episodes at different points in time over the decades. And the message here is we do have pass-through to lending rates to firms and to households. So we do have an effective pass-through. Let me say that's not obvious. The history of the euro area has been from banking systems that are not working properly. So if you have a banking system that's not working properly, it's not necessarily the case that the transmission to lending rates would have been so smooth. But one of the big payoffs over the last 15 years has to raise the capital ratios of banks, make them better performing, and what do we get? We get stronger pass-through into the lending rates relevant for firms and households. But let me emphasize that the decline in the lending rate since we started cutting rates for households, for mortgages, has not been that big. Because remember, mortgages are priced off the long end of the yield curve most of the time, unless you have a kind of a floating rate mortgage. And these rates, as I say, have had a permanent increase. Compared to being very low before the pandemic, they're now 2-something by and large. So there's been a 2 percentage point increase in lending rates, which it looks like it's persistent. So if you're trying to say, well, why is the housing market still in many countries fairly muted? Households have to get used to this world where the cost of a mortgage is much more expensive than it was before the pandemic. And here at ECB, there's also been work reminding you that some people have insulated themselves by having a fixed rate. But a lot of these fixed rates in Europe are 5 years or 10 years. As they roll off a fixed rate they took in 2019 or 2020, they face a higher rate. So even though we've cut the policy rate, many people in the mortgage market, when they refinance, it's more expensive. And again, that's a counterweight to easing. So what we have is essentially an interesting fact that essentially the left side is coming from surveys. We have seen a recovery in demand for loans from households, not much from firms. So part of it is this new interest rate world, and part of it is look at the shocks facing the European economy in terms of trade, in terms of uncertainty, and so on, in terms of the Russia-Ukraine war. And so when you try to think, are we back to normal? On the right side are these credit gap ratios. So some of this are in regulatory mandates to calculate a credit gap. But in general, it's a kind of a goal to say what is a kind of reasonable ratio of credit to GDP. And if you look at that distribution, it's mostly below zero. In other words, credit is lagging GDP in this time period. And the question is that suggesting either that we have this permanent shock to interest rates, or that it's just a lag, it's going to catch up, or have bank credit just become less important? So maybe you should look at non-bank credit, private credit, and so on. And it's simply a change in the structure of the financial system. Well, if you look at how firms finance themselves, and here we include all sorts of finances, not just bank finance. You can see from that graph, it's still pretty quiet. So if your conjecture was bank credit is muted because non-bank providers of credit have expanded, that's a very important story in the US. It's not zero by any means in Europe, but it's not big enough to replace the shift in bank credit. A very interesting issue, and this has been here for a long time, but now with new data sets, and again, I don't know how those of you in academia, how much you've been able to think about these new data sets, such as ANA Credit. So ANA Credit is a big data set, basically recording loans above a certain size across all sectors in the European economy. So you can now ask questions which you could not ask before. Now, there are other loan level data sets at different national central banks and national agencies as well. But if you look here, there's some clear patterns. So on the left pattern, what we see is a big difference between manufacturing and services. So one reason why credit has been muted is, of course, the manufacturing sector, both for equipment and for working capital, typically uses a lot of bank finance. But the European manufacturing sector has been shrinking in many places in recent years because of the rise of China, currency appreciation, high energy costs, and so on. So again, if you're trying to say, okay, it's monetary policy, where is it effective? It looks like it's effective more in the services sector right now rather than manufacturing. But within services, let me emphasize, it's really the green box there is real estate services. So there's a lot there in relation to real estate. And then the other graph on the right panel is indexing by size and riskiness. So what's happening under these conditions, which I think from the point of view of an individual lending officer makes sense, is credit is flowing to large firms and less risky firms. Probably a lot of incumbents. Credit is not flowing so much to smaller firms and riskier firms. So I see various people here teaching business schools, and I'm sure when you think about innovation rates, productivity, dynamism, if credit is not flowing to smaller and riskier firms, then the impact on the economy is going to be more limited. So again, this shows the value of, these were questions I think we couldn't answer years ago. Now we have, I think, important ways to kind of capture that. So in relation to bank loans to households, I said there's been, in the aggregate, a significant increase. Part of that is essentially, as we've cut rates, many households now can, it's interesting, some of the models used in kind of abstract macro seem to work when you think about demand for housing loans. So Tobin's Q, other user cost of capital works quite well for housing. As we've cut rates, it's been more attractive to think about returning to the housing market. But what you see here is two factors. One on the left, there are differences across countries because it's still the case the mortgage market is very national in nature. This may reflect kind of social norms. It may reflect legal incentives. But of course, the pass-through from the policy rate to mortgages will be faster if there's floating rate mortgages than if you have long-term fixes. That topic has been here throughout the history of the euro. people like Rudy Dornbush in the mid-90s were writing papers about how will the euro work with this asymmetry in transmission across countries. And then the other innovation on the right is what we have now, which again, maybe you all are up to speed on it, but this consumer expectation survey. So every month we survey a lot of households in Europe. And this really helps us think about differences across income cohorts and other characteristics. So what you see on the right is there's a lot of asymmetry across income cohorts. I mean, the bottom quintile, they don't have the status to apply for mortgages. What's interesting is the second quintile has the biggest. And this can be interpreted actually more as a sign of financial pressure. These people have seen big increase in the cost of living, and so they really need to kind of find financing. Now, you might say that that's really part of an effective monetary policy transmission. These are probably high MPC households. So easing interest rates that have an impact on this group may be something that's quite important. Much less so at the higher quintile groups. I'm now going to get in severe trouble with my board members upstairs. So let me turn to some other factors here. One is uncertainty. I think you might agree measures of policy uncertainty have gone up, even if financial markets on the right don't seem to price that so much. But what I want to emphasize is uncertainty affects monetary transmission, both in terms of credit demand. Firms and households typically a lot will postpone decisions under conditions of uncertainty. But on the credit supply side, risk is a big part in our surveys of whether a bank is prepared to make loans on easy conditions or whether they want to hold back. So if you're working on how does uncertainty affect the economy, the impact of uncertainty on the decision, the credit supply decision, I think is important. I'm not going to be able to speak coherently about trade beyond saying on the right side, so far the message is banks are more nervous about firms exporting to America than firms importing from America. And again, we're keeping track of that. So again, if the question is, how does trade policy affect the economy? In addition to looking at real channels, looking at the channel in terms of credit supply is also important. So I'm going to maybe just finish with the effect of not just trade policy, but the exchange rate on again, banking systems. So Helen mentioned earlier on the work I did on external balance sheets. But a big part of external balance sheets are the balance sheets of the banking system and more generally the financial system. European banks have a lot of activity in dollars. The good news, it's on both sides of the balance sheet, so a lot of it nets off. But you still want to go bank by bank, item by item. And let me emphasize here, there is a difference in terms of funding. A lot of the liability side is raised from non-bank financial entities. So, one of the big discussions last week at the IMF were the interconnections between the non-bank financial system and the bank financial system. It's been stable and smooth, but, the financial stability wing, I'm sure, has to worry about this kind of dynamic. Okay, I've kind of bounced around there, but if you want the one sentence takeaway, which is, if you say, well, I carry around an elasticity that output or inflation responds to the interest rate by X. Okay, in the end, we do have that kind of macro elasticity, but behind it, we do really have to go meeting by meeting, because what I showed you just there is monetary transmission depends on the shocks hitting the economy. So those shocks have an effect on the real economy, but they also have shocks, impacts on how banks make decisions, non-bank make decisions. And this is why in our overall monetary policy strategy, maybe for those of you who are historians of the ECB, we used to have a segregated analysis. You'd study the real economy over here, and you'd study monetary aggregates over there. And it was like a cross-check. Now, 5 years ago, the strategic decision was you need to do it jointly because the intersection of macro finance runs both ways. And so the overall message, and this is why probably the ECB is so happy to have this macrofinance conference here, is macrofinance is really so central to monetary policy. So with that, let me wish you all the best for the rest of today, but I now have to sprint. Okay, thank you.
Okay, well, after this fantastic speech, once more we learned a lot about transmission of monetary policy, a topic which a lot of academics have been working on, and there's still a lot of mysteries, so still a lot to discuss. We are going to shift to another very important topic, especially in the current context, which has to do with the intersection of economics and geopolitics. And we are going to start with Beata.
Thank you. So thank you very much for including our paper on the program. This is joint work with Giancarlo Cossetti and Banu Demir, and it's about geopolitics. We have seen lots of geopolitical tensions, and one of the dimensions of geopolitics is introduction of sanctions. And even though sanctions have been proliferating in recent years, we actually have a fairly limited understanding of their implications, particularly their implications for third countries. So this is what this paper is about. If you have a situation where sanctions restricting exports from sanctioning economies create a vacuum in the market of sanctioned country, that creates an opportunity for third countries, countries not participating in sanctions, to step in and increase their exports. But firms from those countries have to trade off the opportunity to make profit against the heightened risk of reputational damage and potential secondary sanctions. They also have to take into account the possibility of higher transaction costs and higher risk of non-payment. You know, if you are trading with a sanctioned country, it may be much harder for you to actually do anything if you don't get paid. So in this paper, we have a theoretical framework and empirical analysis looking at this trade-off between increased business opportunities and the increased risk of reputational damage and secondary sanctions. And our empirical setting is Turkey, which is a country not participating in sanctions, but which, due to Western sanctions on Russia introduced after its Russian invasion of Ukraine in 2022, suddenly found itself in a situation where it saw export opportunities in the Russian market. Let me remind you about sanctions, what has happened. Now, Russia started its full-scale invasion of Ukraine on February 22nd, 2022. Western countries responded very quickly with sanctions. These sanctions, among other things, restricted Western exports to Russia. These are exports of military goods, dual-use goods, industrial goods, and luxury goods. Also, most, but not all, banks operating in Russia have been cut off from the SWIFT messaging system, making it much more difficult for them to process transactions in Western currencies. Now, most of the sanctions that I mentioned, these are the sanctions that are relevant to this paper, have been in place by March 2022, so essentially a month after the invasion started. Now, there are many other sanctions. You know, the EU is at the moment on the 19th sanction package, but sanctions relevant to our study were actually introduced by March 2022. And now, from the academic perspective, this is a good laboratory to study the implication of sanctions because of their comprehensive nature and the economy that's subject to sanctions being very large. Right? In many sort of previous episodes, much smaller economies were sanctions, while before the invasion, Russia was 11th largest economy by market exchange rates. And what's very important to understand the context of our paper is Turkey is not participating in sanctions. Right? So that means that firms that operate there are not doing anything illegal if they supply the Russian market. But of course, there is one thing what's legal, what's illegal. There is another thing what the public expects firms to do. In a very nice paper in the Economic Policy, Hart and co-authors produced a survey of 3,000 Americans, and they were asked about their perceptions of how firms should behave vis-à-vis Russia. And 61% of respondents agreed that doing business in Russia is like being an accomplice to the war. So basically what that means is that the public has very high expectations about how firms should behave, and the public expects that firms should cease supplying the Russian market, whatever the cost, right? So the authors of that paper conclude that actually very few people believe in Milton's Friedman saying that, the business of business is business. No, people actually have much higher expectations. And, if you have been following the press, Raiffeisen Bank has been under a lot of criticism because it continued its operations in Russia, as have other entities, including the French supermarket chain Auchan. And there have been a lot of firms, a lot of Western companies that actually decided to exit the Russian market in order to avoid the reputational damage. Now, the other risk that you need to trade off if you are doing business with a sanctioned country is the risk of secondary sanctions. What are secondary sanctions? Their aim is to prevent third parties, right? So entities from countries not participating in sanctions, to prevent them from doing business in countries under sanctions, right? So prime example is, when the US reimposed its sanctions on Iran, it imposed secondary sanctions on non-US entities doing business with Iran. Right? And these sanctions can be very painful. The most severe consequence of US sanctions is cutting off firms from the US financial system, which essentially means you cannot do any transactions in the US dollar, which cuts you off from the US market, both on the import and export side. So looking at the Turkish context, when you look at the residualized Turkish exports to Russia, that's the solid line, and you compare them to exports to the rest of the world, you see the red line, that's February 2022, that's the month of the invasion. There is a dip the following month, and then these exports to Russia go up relative to exports of Turkish firms somewhere else. Now, in this paper, we utilize very, very detailed data. Essentially, think of this as transaction level data. So we know which firm is exporting. We know ownership of that firm. We know the product they are exporting. So these are, if you are familiar with the trade classification, it's 8-digit products. So that's several thousand products. We know the month in which they are exporting. We know the destination country. We know the currency used to invoice this transaction, and we also know the payment method. That's actually something that's unique about Turkish data. We exclude re-export, right? So, there is a separate question of, firms engaging in sanction busting by importing, as intermediaries and exporting further. That's not something we are interested in. We are interested in this decision of firms weighing these export opportunities against risk of sanctions. Now, we have a theoretical framework which builds on work of Crowley and Schmidt-Eisenlohr and co-authors. Essentially, in this framework allows us to think about trade-offs firms face when deciding on currency of invoicing. And actually in the paper, we show that indeed there is a strategic complementarity matters when firms choose which currency to invoice. Operational hedging reasons matter, financial costs matter, but the interesting story really here is the reputational risk, and that's what I am going to focus on. I am not going to talk about other results we have. So, baseline empirical result. So we are doing standard def in def, where we look at an outcome related to trade, so think about value of trade, firm F exporting to country D, destination country D, a product P, again, very detailed product classification, several thousand products in a given month. Right? And then we are asking, are exports from Turkey increasing more to Russia than to other countries after the war starts, essentially after the imposition of Western sanctions, where March 2022 is where this indicator for the post-period kicks in. Now, we are including firm product destination fixed effects, right? So we are looking at a given firm exporting widgets to Russia, let's say, and we are, or the same firm exporting widgets to Germany, and then we are asking, are exports to Russia increasing disproportionately after sanctions kick in? Right? So anything that's related to ability of firm export the given product to a given destination, right? It's sort of taken care of. So we are using the variation over time. Then we also have product month fixed effects, right? So if there's something happening in global markets, with demand for widgets or Turkish ability to produce widgets, that would be netted out. And finally, we have firm month fixed effects, right? So if firm is going through some turbulence and, they are able to produce less or more, that's taken out, right? So within firm month, we are looking, are they exporting more to Russia of a given product than somewhere else? And then we also do a standard event study. Okay, so what do we find? Well, whether we look at value of transactions or quantity, we find that firms from Turkey disproportionately increase their exports to Russia, right? So the war started, European sanctions meant that European and actually US, so Western exports to Russia essentially disappeared. That created a vacuum, and this vacuum is now to some extent being filled by Turkish exporters. Now, if you look at the event study, you see drop in the first month of the war, and then slowly exports are being ramped up and stay at a higher level. But the really interesting question is, are all firms behaving the same way? Now, if you think about who is under greater public pressure and who is more exposed to potential Western sanctions, well, affiliates of Western companies come to mind, right? Because affiliates of Western companies are more visible. They are multinationals. They operate in many markets. They are subject under pressure from their own country, from their own customers elsewhere. They are more visible than other firms. They are much more, on the screen of agencies interested in imposing secondary sanction. And that's indeed what you see. While Turkish firms are enthusiastically exporting to Russia, increasing their export to Russia, this is much less the case for affiliates of Western multinationals operating in Turkey. Is it just, is it the threat of secondary sanctions, or is it reputational damage? Right? The risk of reputational damage. So if you look at the right-hand side, when we focus on exports of products that are subject to Western sanctions, you see that our results are confirmed, right? So if Western affiliates operating in Turkey are unwilling to supply the Russian market with products that are subject to Western sanctions, that is likely that that's because they are concerned about the risk of secondary sanctions. But perhaps more importantly, you see that they are also decreasing their exports of non-sanctioned goods. And that's, and that means that it's the reputational damage rather than concerns about secondary sanctions that are working here. Is this about just Western multinationals, or is it true of all multinationals? So we allow for a separate interaction with multinationals from other countries. Remember, it's only 45 countries that impose sanctions on Russia. And you see that it's only Western multinationals that behave this way, that multinationals from other countries are behaving in the same way as Turkish firms. Now, what are the margins of adjustment? There are several. Well, first, we ask, are Western firms more likely to discontinue supplying the Russian market altogether? Right? So now what we are looking at is exit. Is a given firm F exiting from market D? So what we find is that during the period that we consider, Turkish firms are less likely to exit the Russian market than they are to exit any other market. But Western multinationals are actually exiting the Russian market. And you even see it in the raw data when you do simple counts of firms. So they are 18% more likely to exit the Russian market than any other market. Now, you may also focus on the intensive margin, so on continuing exporters, and you see that continuing exporters decrease their exports to Russia more than to any other market after the war starts. We also can look at whether firms introduce new products. So you see that Turkish entities are more likely to introduce new products in Russia rather than in a different market, but Western multinationals are not doing that. Now, I mentioned that doing business with Russia in terms of processing transactions is hard because majority of banks operating in Russia have been cut off from the SWIFT system, right? And you see it here that firms are decreasing the share of their exports that are denominated in Western currencies. So you see that after the war started, Turkish firms decreased the share of their exports denominated in the US dollar by 5 percentage points and their exports denominated in euros by 3 percentage points. And what is happening? Well, what are they doing? They are increasing invoicing in Turkish lira. And, if you, in a sort of separate work, I look at the other side, I look at what has been happening in Russian imports from the world, you see very clear shifts away from the US dollar as a vehicle currency, as an invoicing currency, and shift to producer currencies, and a shift to renminbi as an international currency. So there are quite pronounced changes. Now, if you have been following what has been happening to the Turkish lira, you may have doubts about whether this is a good decision, right? There has been a lot of volatility in Turkish lira, so why on earth are these Turkish exporters invoicing in lira? The answer is very simple. They are demanding cash in advance. So the share of exports that are going on cash in advance terms has increased by 6.5 percentage points. So they are getting paid before shipping the goods, and that's consistent with protecting themselves against the risk of non-payment, and that's also a way of dealing with the volatility of the currency of invoicing. Now, what these firms also do is they are increasing their prices. So we can look at unit values, right? So this is the value of the transaction divided by quantity, and you see that they are that Turkish exporters are increasing unit values by about 4%. Right? So that's actually, I must say that if you look at Russian import data, you see similar numbers. So the price of goods that are being imported by Russia is actually not increasing by tremendous amount. Interestingly, Western multinationals are not behaving differently from Turkish firms. So those that still continue exporting and supplying the Russian markets, they are also benefiting from the higher prices. Now, Giancarlo and his co-authors, they have come up with a method for netting out markups from the trade data. Essentially, this is based on demeaning, by firm product and then by firm product and the trading pattern. I'm not going to go into the details, but the bottom line is that if you conduct that procedure and you net out proxies for production costs of products going to particular collection of markets, you find very similar result to what you see in the raw unit values. Markups go up by 4%, and there is no difference between Turkish exporters and Western firms in terms of this increase in markups. Now, how important are these barriers, these, in a sense, self-imposed restraints on supplying the Russian market? Well, what you can do is, using trade elasticities, you can express them as in terms of equivalent tariff. Right? Now, of course, the literature has a wide range of estimates of trade elasticities. So here we've done calculations for several of them. But essentially, these self-imposed restrictions by Western affiliates by Western multinationals are equivalent to a tariff, between 25% to more than 300, depending on which elasticity you assume. So they are not insignificant. And I think in one of our back of the envelope calculations, we show that they are foregoing the opportunity on average to export about $50 million. Now, the final question I want to mention is what always comes up is, are these firms increasing total exports, or are they pulling goods that they were sending somewhere else and now redirecting them to Russia because the profitability of those exports is higher? Now, there isn't a sort of obvious way of doing that, right? Because you want to look at total firm level exports. So you need to somehow link that to the opportunity to export to Russia, But of course, everything, could be endogenous. So what we do is we ask, is it the case that firms who were exporting more to Russia prior to the war, in terms of the share of total exports, do we see that they increase total firm level exports more? And that is true. Right? Second, we ask, is it the case that firms for whom goods that would come under sanctions in 2022 were more important in export portfolio? Are those the firms that see their total exports going up? And the answer is yes. Right? The logic here is that firms are happily exporting. Suddenly, sanctions come in. European exports of sanctioned goods to Russia disappear, so there is particular export opportunity in those particular goods. So those firms that were exporting more of those products in general have the ability to do it. And that's exactly what you see. You see this for all firms. You see it for you see it for Turkish firms but not for Western multinationals. So here, others are meaning firms other than Western multinationals. So to conclude, we consider the impact of sanctions on a third country not participating in sanctions, whose firms have to consider the trade-off between export opportunities and the risk of secondary sanctions and reputational damage. We show that this risk indeed seems to matter, as Turkish firms behave differently from Western multinational. Turkish firms take advantage of the export opportunities, while affiliates of Western multinationals operating in Turkey choose not to do so. The results are consistent with both reputational effect and the threat of secondary sanctions being the drivers, because we see similar behavior when sanctioned goods are being traded, so goods subject to Western sanctions, as well as non-sanctioned goods. And we also see that risk of non-payment shifts firms to demand cash in advance, and also difficulties of processing payments in Western currencies shift firms to rely more invoicing in Turkish lira and less on invoicing in the US dollar or the euro. Thank you.
Very much, Beata, and the discussion is Theodora Tetti. Yeah, first of all, thank you so much for inviting me. Thanks so much for giving me the chance to discuss this super cool paper. I'm first going to summarize a little bit, although Beata was super clear. And then I'm going to go through my main comments. I don't have that many, but I'll promise I'll have something that we maybe can use later to discuss. So what does this paper do? So it essentially asks how are Turkish exports to Russia affected by Western sanctions on Russia? Why is that interesting? Well, because Turkey did not impose sanctions, so this is really a third country effect in a sense. So it essentially takes a step back and says Turkey is not actively sanctioning Russia. So how does a change in the trade costs between West and Russia affect Turkey? I think this paper does essentially three things. So first of all, it asks in general the question, do Turkish firms increase exports to Russia relative to other destinations? Then it asks, does reputational risk limit firms' ability to benefit from the new export opportunities? And lastly, it also tries to speak a little bit on the margin, as Beata was saying. I gotta say, the presentation is much more streamlined. As in, when you read the paper, especially in the beginning, it's not 100% clear what exactly they want to focus on. But it becomes clear later on, that it's really the reputational risk. So how do they do that? First of all, they have extremely cool data. If you work in trade, I'm sure you've heard about the Turkish firm-level data because they're really great. They are, as Beata said, they're pretty unique, especially because they record this payment. So more information on the payment choice and so on. So it's essentially the main specification is a relatively standard diff and diff. So maybe just to note, it's at the firm level, and this allows them to include a very, very rich set of fixed effects. So I think the most important one being that they have the firm, product, and destination fixed effects. So they really only look within those cells and only use variation over time. They have, I think, 4 sets of results. The Turkish exports to Russia increased by 33% relative to exports to other destinations. The reputational risk really matters, and so that means it constrained firms with higher Western exposure from expanding trade with Russia. Turkish firms adjusted by switching to cash-in advance payments and invoicing in Turkish lira to reduce risk exposure. And lastly, also, there is an exit of, the exit of Western competition increased Turkish firms' market power, leading to higher prices and markups in the Russian market. As I mentioned before, so the set of results that they really care about is like the reputational risk thing. So yeah, this paper is great. I recommend to all of you who are interested in this kind of topic to read it. So now let me just briefly talk about like the four big, or not so big, but like the four points that I want to mention. So first of all, like that's actually my biggest comment. I think so. It's not that surprising that Turkish exports increase. So this is actually a very standard result that we would expect just from standard gravity type of standard gravity theory in a sense. So what happens is the trade costs between West and Russia go up. And that means automatically that everyone else is going to trade. So everyone that is not involved in the sanction regime is going to trade more with Russia. So that's something we would just expect naturally. So that's something that gravity gives you essentially, which we call trade diversion. And so I think that's why. So the way that the paper is set up, I mean, you essentially get like a number, so by how much Turkish firms gain, but it's not necessarily telling you that much, like how much we should expect it to go up. So my point being, if you think, so the ideal counterfactual will be that you have a world where you see once sanctions, and then, for example, a tariff between, so just a normal tariff that goes up between Russia and the West, and then you would compare those two coefficients, and then the differential between those two coefficients, that would be the interesting part in a sense, because that tells you how much, because of the reputational risk, the Turkish firms are not reaping all of the benefits. So it would be what I just described. That would be one way of doing it. Another way would be to have a full set, like a full GE type of model that we have a lot in trade. Why? Because also there you could compare what would we expect, like in a world where we're not in a sanction world. So how does that relate to? Or how does that compare to a world where we have sanctions? And so you can really isolate like the reputational cost. Yeah, as I said, maybe. So I think I see two alternatives here. One way would be to go with like a full scale like GE model type of thing. I don't think that's like the flavor of this paper. So if the authors wanted to do something along these lines, they could, for example, use the Trump of the first Trump administration, those tariffs, because that's very similar, as in there's like a shock between two countries, and then you could check like how that affects Turkish firms. Lastly, so this is a little bit of a cheap comment. So usually in trade, what we would do is we also wanna control for changes in the demand essentially. So in this case, in Russian demand. So what I'm thinking about is, I mean, Russia is going to war, no? Like, so it could be that instead of having demand for like a Louis Vuitton bags, now they really need like shoes for soldiers. And so this is a complete switch in demand, and that could lead to an omitted variable bias. This is something that usually in trade we can easily account for by including essentially importer time fixed effects. In this setting, this is not possible just because the data is only contains one exporter and not many exporters. Yeah, so that's not really. So in this setting, this is just not really possible to address, but maybe the authors can think about something what to do with this comment. Yeah, and so Beata didn't really talk about the model. We talked about this a little bit yesterday over dinner. So in the paper, there's a section there's like a model in the paper. As of now, to me, it seems a bit disjunct from empirics. So it seems to be focusing not so much actually on the reputational cost, and that is something. So it's much more focused on like the payment side of things. It also has it has very sharp predictions on the payment, but not so much on the reputational risk. So I think here on this, I hope that in like further iterations, this is going to be closer to the empirics and mapped much closer to the empirics. Yeah. Lastly, I was a bit surprised because in this setting, it seems like the extensive margin, so essentially firms dropping in and out of whether they export or not, that matters quite a bit. They talk a little bit, in the paper about the extensive margin, but I was kind of surprised that they didn't use in their baseline results PPML and levels instead of OLS and logs, just because with the PPML and levels, it would include essentially, so it would be a mixture of like the intensive and the extensive margin. In the log OLS, it's just an intensive margin. And then also overall, I think, so I got at times a little bit confused about for which table, which sample it actually is, like that's something I think it could be much clearer on, like just to keep the reader, like to help the reader understand like what exactly is happening, which firms are we looking at, and which ones we're not. But again, I think this is something that the next iteration is going to be much nicer. I have a couple of points that I thought about while reading that I found very interesting. I mean, this is not something that I feel like the authors have to do, but it's something I thought was kind of interesting. One, for example, in the event studies, it looks like there's like a little bit of a decrease from June 23 onwards, and I was just wondering whether the authors can say something about that. And then lastly, I know this is probably not part of this paper, but what I would also find interesting is whether you could say something about jobs or something about like more on the Turkish side, so whether this is actually something that helps Turkey to find jobs, because then, so it has important implications in terms of also coalition building. So if Turkey wins a lot by engaging in or like by not sanctioning Russia, then it's going to be very hard to get Turkey on as a part of the coalition. So I have a couple of minor ones, but yeah, exactly. Great paper, so everyone should read it, and thanks for letting me discuss it. Thank you.
Wonderful. So I'm going to leave you the opportunity to respond a little bit, not too long, but
okay.
Yeah.
So very briefly. So thank you very much, Fedora, for very useful comments. It's absolutely true. Paper is not streamlined, and but there are these things because it is an evolving project, and it has been evolving. The draft has not quite caught up with the latest thinking. But let me respond to 2 points. One is trade diversion. Yes, this paper is about plain vanilla trade diversion, right? But why is it interesting? Some of you may be familiar with Chicago Booth expert panel, where economists are asked periodically to opine on various matters related to economic policy. In March 2022, so a month after the war started, both the European and the American panel were asked the question: sanctions on Russia already in place will lead to, I believe, financial and economic crisis in Russia. 90% of people agreed or strongly agreed, and these are results weighted by respondents' confidence. So economists were very confident these sanctions would have brought about financial crisis in Russia. And in my job at the EBRD, that was the question that I was most frequently asked by journalists: when is Russia going to see financial crisis? Right? So, trade diversion should have been an obvious thing, because if 141 countries at the UN condemned the invasion, but only 45 countries participated in sanctions, but somehow it has not entered the public mind. So in a sense, what you are suggesting is to compare regular trade diversion under some sort of trade policy change to trade diversion driven by sanctions, right? That is the point of your first comment. So the way we think about this is we think that Turkish firms, that's the regular trade diversion, and multinationals, that's different behavior because they are worried about sanctions. Second, you ask, is there something different about the portfolio of products supplied by multinationals that made them better or worse positioned to take advantage of the opportunity? So the way we think about this is, again, the sanctioned products versus non-sanctioned products, because opportunities were greater in sanctioned products. But thank you very much for your comments.
Fantastic. All right, so I can see. So I'm going to start, yes, and then.
Thank you. Thank you, Larissa Schäfer from Frankfurt School of Finance and Management and ECB. Very interesting paper. I've actually spent some time at EBRD, very great work that you always do. I have a question about this reputational mechanism, because on the one hand, you're saying that the multinationals are cutting down because they are fearing probably reputational damages. And as I understood, you're not taking this import side into account, but could it be similar what you see in US, that basically the firms, the Chinese firms are rerouting via Mexico and Canada to US, and a similar thing happens in Turkey, right? That you see more imports maybe from Western countries or even government-owned countries, I don't know, companies through Turkey, because that's also related to the point of the discussion. The portfolio that the Turkish economy is offering is not, product portfolio is not the same as it is in the EU, so it might be that they're rerouting to the Turkish market. Thanks.
And we're going to take. Yeah, we take 3 questions.
Please,
and
please.
okay, you run and okay. Now you run. You are second. I insist.
Thank you. You're a Chicago booth. Just curious, how does this compare with trade with India, or let alone China, in terms of magnitude and impact?
Arnaud Mali, CB. I was wondering, Beata, whether you also could use the imports data to shed light on this reputational mechanism. There is a discussion in the EU now on the 19th package on secondary sanctions that we could impose on countries which continue to import Russian oil to fuel the Russian oil machines. So there are goods which are specifically, let's say, likely to trigger secondary sanctions, and whether this could be those ones that could be helpful to shed light on this effect. But paper is super good, so I like it a lot.
So thank you very much for the comments. We are not looking at Russian exports of oil because other people have looked at this. So Elena Rybakova, for instance. So that's why this paper is sort of much more smaller. How does it compare to trade with Russia, with India, China? So, you know, I have other papers that use aggregate data, and essentially you see exports from China to Russia increase. And, you know, Turkey and China are the 2 countries where you see the biggest increase. You also see rerouting via Kyrgyzstan, Kazakhstan, Armenia. You see also goods destined to, you know, exports from Western Europe to Kazakhstan, Kyrgyzstan, and Armenia getting lost in transit. So essentially, you know, if you compare what Germany reports as being exported to these countries versus what they report as being imported, suddenly, after the war starts, many of those goods get lost along the way. And this is true for sanctioned goods, not for goods that are not subject to sanctions. So all of this is happening. In terms of the reputational mechanism and rerouting, so we intentionally excluded re-exports, but you know there could be something else. So we have a table in the paper where we ask, are these firms exporting goods that they imported from Europe in the last 2 months? And the answer is yes, there is some of that happening.
On this, why did you exclude rerouting? Because that sounds like a very interesting question.
So one reason is there was another team working on that. Okay. I don't know whether they have done it. And then, you know, rerouting you also see in aggregate data. I mean, in principle, you know, we've done the analysis with re-exports, without re-exports, continuing exporters, including new exporters. You know, the numbers, the magnitudes change somewhat, but the message is the same.
Okay. Other questions? Because I just had a follow-up on this, but I guess what is especially interesting is also all these dual-purpose goods, right? So in disaggregated data, you can say more about this.
Yes. So so when you look at so we actually do it in the paper. You see that exports of all types of sanctions, goods subject to Western sanctions, increase. You see it in aggregate data that, you know, round tripping and goods that get lost in transit. These are particularly goods that are subject to sanctions. So you see all of it. Now, we have also another set of results I didn't talk about, is that the multinationals, the foreign affiliates that are most sensitive are those that have US ownership. So essentially, if you have at least 10% of US ownership, you essentially don't increase your exports at all to Russia. Now, we also tried to look at the related question, do you behave differently if you are supplying the Western markets, let's say European Western market? It doesn't seem to be the case. So it seems like the US secondary sanctions are the most scary ones, because firms with US ownership seem to react the most.
Very good. It's time for a very last question. All right, then you are gifted a bit of time too. Thank you so much.
Thank you.
And now we have Leslie Shen. Thank you very much, Leslie.
Well, thanks a lot to the organizers for putting together this excellent conference and for including our paper on the program. My name is Leslie Shen, and I'm from the Federal Reserve Bank of Boston, and this is joint work with Frederick Gniepen from the Federal Reserve Board. Everything I say today are our views, not that of the Federal Reserve System. All right, so geopolitical risk has become top of mind for policymakers, market participants. And that's evident if you read meeting minutes from key policy meetings, whether it's the ECB monetary policy meeting or the FOMC. And also if you look into speeches and board meetings by key firms in the economy, such as a quote here from Jamie Dimon from JP Morgan, it's evidence that geopolitical risk is something that people are very worried about. And indeed, there are reasons to think why geopolitical risk may be distinct, because it often involves catastrophic scenarios, expropriation, breakdown of legal order, and extreme uncertainty. Yet, the financial international mechanism through which geopolitical risks are transmitted is still to be understood. As you can also already infer from the title of this paper, the focus of this work is on banks. We want to understand the relationship between geopolitical risk and banks. And especially global banks, they're inherently exposed to geopolitical risk given their global jurisdiction. And with the outbreak of the Ukraine war, there were a lot of reports that came around that time wondering about the extreme uncertainty of Western banks that had exposure to Russia and the outcomes and how they're responding to that. And understanding this question is particularly important given the long established literature about the importance of credit supply decisions by banks for the real economy. So for this paper, we're going to focus on two questions. First, how do banks respond to geopolitical risk? Is this response distinct from other macro risks that we have studied? Second, what is the implication for domestic credit supply? So essentially, is there spillover effects? So the focus of this analysis is on US banks. And we're going to conduct analysis into three components. The first component, we're going to construct measures of bank-specific geopolitical risk indices using both established and newly constructed country-specific geopolitical risk index. And the second is the empirical component of our paper. And we're going to ask, how does geopolitical risk shape US banks' foreign operations? And whether the increase in geopolitical risk abroad affect domestic lending. And for this component of analysis, we're going to use several supervisory data that the Federal Reserve have access to. And that includes the FRY14Q that many of you may have heard of. That is data at the loan level, and it has information about the riskiness of the loan, the origination amount, and we have information about who are the borrowers and the country of the borrowers. The second data set we're going to use is what's called FFIEC 009. that is a country report of exposures by US banks across the world. So this data is at the bank country time level, and we have information about the exposures of the different US banks. And in particular, we have information about the mode of operation. So we can see, for example, hypothetically, Citibank, how much it is exposed to, say, Russia directly from Citibank US versus Citibank that's operating in Russia, so the affiliates. The form of which we call cross-border claims, the latter is called local claims. And we also have done some work using the SLOOS data, and this is the confidential version of the SLOOS that's at the bank level about bank lending standards. I'm not gonna have time to get into detail about that, but this is another margin of domestic spillover that we look at. So with empirical analysis, we're gonna then introduce a simple model that help us to explain the results that we're going to show and help to clarify the mechanisms. All right, so here is a preview of the main findings. On the empirical front, we established 3 main findings. The first is that an increase in geopolitical risk increases the credit risk of the exposed banks. Second, US banks, they do reduce cross-border lending to the countries that's experiencing increased geopolitical risk, but their lending through their affiliates in these countries continues despite the rising credit risk that we find in the first step. And moreover, we find that banks do not adjust their foreign exposure similarly in this asymmetric way in response to other macro risks. And third, on the spillover effects, we find that in response to higher geopolitical risk, banks reduce C&I lending to US firms, and they also tighten lending standards in terms of domestic loans. And this effect mostly stem from geopolitical risk in countries where banks have these local operations. And in terms of model, we're going to show that these results can be explained by 2 key factors. One is the differences in funding structure between a local operation versus a cross operation, combined with some of the unique nature that comes with geopolitical risk, which you can think of as destruction in asset valuation that could come from, say, expropriation risk, physical destruction, profit repatriation frictions. And the key idea there is that foreign funding, which foreign affiliates receive, can limit the downside losses for the bank. So I'm going to go into detail about each of the components of analysis. So first, let me give an overview about how exposed are US banks to foreign economies. So the left chart here shows foreign exposure as a share of total assets of US banks. So about 20% of US banks' assets are foreign assets. These are the most internationally active banks that you probably are thinking about in your head. And the right side shows local exposures. So how much of that exposure come from the branches subsidiaries that these banks have in these foreign countries as a share of total exposures. And around half of banks' foreign exposures stem from assets in foreign branches and subsidiaries. And this is a more granular view where we take 4 active international banks, US banks, and look at the countries they are most exposed to over time. So 2010 on the left chart, 2019 on the right chart. And the key takeaway here is there's tons of heterogeneity in terms of how banks differ in terms of geography and magnitude of exposures across different countries, and this heterogeneity also changes over time. And with that in mind, we're going to construct a bank-specific geopolitical risk index, BGPR. And this BGPR at level of bank B time T is a weighted sum of the country-specific geopolitical risk index, CGPR. And the weight is using the exposure of a given bank to a given country by the overall assets of the bank. That includes the domestic assets. And we have various constructions. So the main baseline one is 4-quarter weighted average. We also use other variants for robustness. Now, the key question here is, what do we use for country-specific geopolitical risk index? So we use two sets of measures. One we view as kind of a more established one, as some of you may be familiar with, the one by Dario Cadara and Matteo Iacovelli. And they construct a newspaper text-based method to construct this country-specific geopolitical risk index using the dictionary words that captures geopolitical risk. And so whenever you see a subscript N, that's a newspaper-based measure. And then we're going to supplement that with something that we construct, use firms' earnings call transcripts. So we're going to use the same dictionary as Cadara and Iacovelli, and we're going to use the methods a la Hassan et al. To capture, which the measure captures firms' perception of geopolitical risk, and we aggregate that up to the country level. And we mainly view as additional set of robustness to the main measures that we have. And it also allows us to kind of get deeper into different dimensions. Since we're aggregating from the firm, we can see which type of firm, as well as divide that into some words related to threat, some related to acts. So let's now look at these measures at the global level. So the left side are the geopolitical risk indices. The top one is the newspaper one, and the bottom is the one we construct. And at the global level, you can see the spikes are driven by major wars: Iraq War, Russian-Ukraine War, and the Israel-Hamas War. And on the right, we compare that with some of the more established risk measure that's known. The top right is the one by Hassan et al. Using the earnings call methodologies that we use for our measure, but just looking at economic uncertainty in general. And what's picked up there in terms of spike is global financial crisis, debt crisis, COVID. And the bottom right is the World Uncertainty Index by Nick Bloom and co-authors. And there also you can see what's driving some of the spikes are debt crisis, US fiscal cliff, and COVID. And we can also look at this at the country level. So this is just an example looking at Poland. The left panel are the geopolitical risk indices, and we see that the spike really came after Russian invasion of Ukraine. And the right are the various economic indices, including now the CDS spread on the bottom right. And there the spike is also the global financial crisis, European sovereign debt crisis. So from there you already see some distinct factors related to geopolitical risk relative to some of the other risks that we've been studying. So now with that, let's look into the empirical results. The first set of results is going to concern whether banks are accounting for geopolitical risk on their balance sheet. So we measure credit risk based on the weighted probability default of these loans from the credit registry, the Y14 data. And we conduct this analysis both at the bank country level as well as at the bank level to see if the size is enough to even show up at a more aggregate level. And what we find is that banks, they indeed take that into account. They assign a significantly higher probability default to existing loans to countries that's experiencing an increase in geopolitical risk. And that effect is substantial enough to show up even at the bank level. And we also look at an event study focusing on pooled two events, looking at Russia's annexation of Crimea in 2013, as well as invasion of Ukraine in 2022. And we see a huge spike in the credit risk that's assigned to loans that's exposed to Russia relative to all other loans on these banks' balance sheet after the shock. So the first takeaway from this set of results is that geopolitical risk increases US banks' credit risk. Now, how do banks respond given this increase in credit risk? Now we're looking at how their foreign exposures are affected by the geopolitical risk as measured by the country-specific geopolitical risk measure. And in particular, we divide this foreign exposure into the cross-border component and the local claims component. So the red results shows on the cross-border front, we indeed see that banks divest their exposures to countries that's increasing geopolitical risk. But surprisingly, on the local claims front, we do not see a significant response. And these set of results control for bank country fixed effects, as well as bank time fixed effects, as well as some macro controls that includes the stock prices, the exchange rate, and indicator for whether there is a sanction imposed on the country. And now, do banks respond in this asymmetric way to other shocks, to other economic risks that we have traditionally been studying? So now we're kind of running the same regression, but with the other risk indices I showed earlier on the right-hand side. And we do not see this asymmetric response. So that suggests that there is something distinct about geopolitical risk here. So the finding two here is that banks continue to hold local claims in response to increase in geopolitical risk, while they do divest on the cross-border front, despite the increase in credit risk, unlike their response to other economic shocks. And third, we want to understand the implication for domestic spillovers. And for this, we're using the loan level Y14Q data at the loan origination, with loan origination as the right-hand side variable. And we use the bank-specific geopolitical risk index that we construct on the right-hand side. So we control for various bank characteristics, loan controls, as well as firm time fixed effects. So this is looking at firms that is borrowing from multiple banks, controlling for potential demand responses by firms to geopolitical risk. And we're restricting our sample to just US firms. So this is really isolating kind of the domestic component, trying to understand whether there is spillover effects. So I'm going to show results at the loan level. We also have conducted it at the bank level, and the results all hold. So this is the baseline table for the spillover effects, where we look at the loan origination on the bank-specific geopolitical risk indices. And we see a strong negative relationship. So an increase in bank-specific geopolitical risk as measured by our BGPR measure reduces the loan origination by these banks to US domestic firms. And the results are very consistent whether we add additional macro risks as our control variables, and also whether we use the newspaper-based measure or the earnings call-based measure. Then we proceed to ask, given the evidence that we showed about the asymmetric response of banks in terms of cross-border versus local to geopolitical risk, whether the risk is stemming from local claim exposures of these banks. So to that end, we decompose our bank-specific geopolitical risk measure into the exposure that's just coming from the local component versus the component that's coming from the cross-border element. So the first two columns, the result is purely looking at the BGPR stemming from the local exposures, and we see a strong negative relationship. Well, in column 3 and 4, we look just at the cross-border component, and we do not see a strong effect. And column 5 and 6, we combine both, and we see that even with that, the effect of BGPR on loan origination is significant when stemming from countries where banks have affiliates. So with these results, the third results that we establish is when geopolitical risk rises abroad, US global banks curtail domestic lending, particularly when they operate affiliates in these affected countries. And we have additional set of results looking at bank lending standards that's consistent with what I have shown on the loan origination front in terms of spillovers. So then we want to move to know, how do we think about the mechanism that's driving these results? So we construct a simple model, but we think that's helpful for illustrate and clarifying some of the key mechanisms that may be driving these results. So it's a 3-period model with one bank, and bank is endowed with equity, subject to a leverage constraint that's Basel III style, so perfectly mapping what the regulation exactly accounts for when they think about these leverage constraints for global banks. Banks decide how they want to allocate funds between domestic and foreign lending. So they could do domestic lending, which is 1 period, risk-free and variable, or they could do foreign lending. It's 2 period, uncertain, fixed in amount. And they could do this through 2 modes. It could be cross-border, in which case it will be funded by domestic deposits. So it will be US deposits that will be funding these type of lending. Or it could be through foreign local affiliates. Again, some fixed cost, but that part, it will be funded partially by foreign deposits. So these deposits that they could collect from the countries that they operate in. Now, foreign investment could be exposed to geopolitical risk. If a geopolitical event were to occur, the investment would yield no return. And the motivation there is, we think about the loss of asset values that could result from an expropriation, asset seizures, or destruction. In which case, banks would not be obligated to repay the foreign depositors. So this is the most extreme case, but all the mechanism of the model would hold if we think of milder cases of such scenarios, as long as there's a sizable decline in return that could be come along with costly repatriation frictions, for example, that will prevent banks from repatriating profits home. So this is a picture of the basic idea of the model. In particular, I want to point out that in period 1 of the model, the banks learn about whether geopolitical risk is high or low. So state, good state or bad state. And they can make a decision about liquidation at that given point in time. Banks can liquidate their foreign investment, but subject to some cost. But if they were to liquidate, that will eliminate the risk of coming from geopolitical disruptions. So the continuation value of the local investment is higher than the cross-border investment because the liabilities will be defaulted in a bad or high geopolitical risk state. So as you can already see from here, the model predictions are aligned with the findings about geopolitical risk and foreign exposures. Banks are more likely to liquidate cross-border investment than local investment, and this gap becomes more pronounced as geopolitical risk increases. And there's an additional prediction here. Banks are less likely to liquidate local investment the more it is financed with local liabilities. And we test this prediction where we interact the country-specific geopolitical risk with local liabilities of these banks. So this is the same regression specification as the foreign exposure from the earlier slide. And as you can see, the interaction term on these country-specific geopolitical risk and local liabilities are positive and significant for the local claims and insignificant for the cross-border. So this shows that banks indeed, they're withdrawing less from markets that's funded more by local liabilities. Now, we further solve the model to understand the relationship to domestic lending. And overall, the leverage constraint from there, you can already see there's a higher risk weight assigned to foreign loans. So the banks need to readjust their balance sheet elsewhere. So that will lead to a decline in domestic lending. So the model prediction on that front is also consistent with what we showed before about domestic spillover effects. So banks exposed to heightened geopolitical risk through foreign operations would reduce their domestic lending more. And the spillover effects would be larger when banks operate through affiliates because kind of the liquidation is less likely in these scenarios. And there's also some predictions about the spillover effects are larger for banks with lower capital ratios and profits, for which we also test using our data where we interact the bank-specific geopolitical risk index with the capital positions and profitability of the banks, and we find results as consistent with the model predictions. So on here, I want to say a few words about some of the mechanisms we're thinking about. We think that one of the kind of stark examples of geopolitical risk may be expropriation risk. And if we look back into history, geopolitical risk has heightened the likelihood of expropriation. We have seen various cases starting going back to 1917 with the Bolshevik Revolution through World War II, and more recently was Russia's invasion of Ukraine, where Western assets are seized under these scenarios. But of course, we don't have to go to this extreme state. Softer forms of state interventions can also lead to the same mechanisms. And we have done some work on this front where we've constructed an expropriation risk index at the country level, and we correlate that with our geopolitical risk index, and we see that the variation in these two indices are very much aligned, conditioning on country and time fixed effects. So let me conclude. Our papers established 3 findings on geopolitical risk and banks' foreign and domestic operations. We see that increase in geopolitical risk increases the credit risk, and banks respond by divesting from the cross-border front, but not as much from the local front, and that's unlike their response to other macro risks. And we see a significant spillover effects. And we think that foreign funding from these affiliates can partially offset the losses through a reduction in liabilities, so lowering kind of net losses, and that's maybe a key mechanism that's at play here. Thank you, and look forward to the discussion.
Thank you, Leslie. And the discussant is Veronica Di Falco. Hey, Veronica.
Thank you. Good morning, everybody, and thanks so much for the organizer for inviting me to this great conference and discuss this very interesting paper. So let me start by quickly summarizing the research question and the main findings of the authors. So the research question is broadly, how do these banks respond to increase in geopolitical risk? And the context in which the authors are studying this question is the US banks that have foreign exposure during this time span of 1986 to 2022. And the main findings are very simply summarized as follows. When geopolitical risk increases, somehow not surprising, cross-border lending goes down. Interestingly, the lending that happens through foreign affiliates instead remains quite stable. And more importantly, I think the result I actually like the best is the one about the domestic spillover lending, which I think it's very cool and I think could be emphasized more in the paper, which is about the effect to the home economy, so the US, the economy and US borrowers. My overall assessment is that this is a very timely and nice executed paper. They have great data coming from supervisory balance sheet data of banks, and contributes to this new growing interest in the intersection of geopolitical risk and macro-financial stability, but also more broadly to a very long-standing literature that has been studying what are the determinants of international capital flows. It is very important also for policymaking, thinking about what kind of factors should we think about and observe when it comes to the international bank structure and the effects of the bank structure on potential spillovers. My comments are going to be mostly on this result that cross-border lending and local affiliates lending are different. And I'm going to talk a little bit about the identification of this, then about whether this is indeed some asymmetry that is specific to geopolitical risk. And then I'm going to conclude a bit with some thoughts about the paper, regulatory implications, and a bit the framing in the literature. So the first point I want to focus on is this test of whether the cross-border lending and the lending through affiliates are indeed different from a structural perspective. And one thing, of course, that comes to mind when you think about this research question is it is potentially an endogenous choice of the bank to choose whether to lend via cross-border or actually open up a subsidiary or a branch in a specific country. And so ideally, if you want to think about how is the lending changing given a geopolitical shock, you would like to kind of hold things, the bank and the borrower, and really compare how the cross-border lending and affiliate lending change, one compared to the other. Now, there is a concern that indeed there could be sorting, the traditional kind of banking sorting issue of the bank might be sorting with different borrowers in different countries, and in particular also the way in which they lend might be endogenous to the type of borrower, say the industry, or the risk of the borrower. Now, there is a data limitation, so there's a certain amount of things that the authors can do and cannot, of course, do, given the data. Ideally, you will need to have a cross-country credit registry that also allows you to look at what is the type of lending and how is it done. Is it cross-border and is this affiliate lending? But so what are the authors doing? So they're doing a good job because they're already including a bunch of important fixed effects. So bank-by-country fixed effects allow you to sort of take care of whatever sorting that it's static over time. And they're also including banks-by-time fixed effects that are going to allow to sort of compare borrowers within the same bank. But when it comes to this comparison of is the cross-border lending and the affiliate lending different, most of the regressions are using kind of a split sample approach that is comparing the two effects in separate kind of regressions estimation. And I think in this particular setting, this can be a little bit concerning because there is only a subset of banks that are actually choosing to operate through local lending. And so if you look also in the tables at the number of observations, the banks that are using local lending are very few. And so I wonder whether there is actually composition effects here that is driving potentially the comparison for which you're comparing sort of different sets of banks and country sorting. And so there are very small things that you can do to sort of attenuate this risk, which is estimate a pool regression with an interaction term rather than sample split, or restrict the sample to bank-country pairs that have both the cross-border and the local lending channel. Also, I think the paper could benefit from having a bit more summary statistics that allow us to sort of think about how are the banks and country exposure different and whether there is any sorting. The second point I want to raise is whether this asymmetry that it's found is really specific to geopolitical risk. And in particular to this idea in the paper, what is the mechanism? The mechanism is potentially, because of geopolitical risk, there's going to be expropriation risk. And the expropriation risk mechanism is corroborated by evidence that the reduction in lending is lower if the bank is using local deposits. So there is local funding. But, I mean, there's a long-standing literature on this topic. So, one of the papers that I'm picking on is a Schnabel paper that also shows that there is some similar asymmetry when it comes to transmission of liquidity shocks between cross-border and affiliate lending. And so I wonder how much this is really a specific feature of the geopolitical risk or a broader feature of the financial architecture of banking. And what the authors do is that they use other risk indices that Leslie has showed you to look at whether this asymmetry stands also by testing for different macroeconomic and financial indices. And I think what the authors could do to sort of provide more information about this is give us more comparison information between the geopolitical risk index that they're using and the other macrofinancial risk indices, as well as kind of similarly to what I mentioned before, kind of hold the sample constant across these specifications, given that some of these risk indices might be available for certain countries in certain periods of time, but not for others. Lastly, kind of broader kind of picture points. As I said initially, I really like this point about the financial spillovers to the domestic economy. because this has broad implications for how we think about stress testing, what kind of factors should we look at, and macroprudential policy. And so one suggestion I have that I think would enhance the contribution of the paper is to quantify more the magnitudes of these spillover effects and also give us some examples of like major events that have produced major spillovers in the US economy and potentially minor events that instead had relatively lower impacts. Finally, I want to sort of bring the paper also a bit, the paper is very well set in the international banking literature framing, but I think the results are interesting and could be also be framed closely to the more international capital flow literature, and in particular, you know, these old frameworks of push and pull frameworks and the global financial cycle, and thinking a little bit about, I mean, these are my thoughts, but you know, in principle, you can think about geopolitical risk as a potential kind of push shock that it's changing the capital flows from the US economy to other emerging markets. And this asymmetric response across lending modes can sort of be potentially a structural kind of pool side component that can explain maybe the heterogeneity across international capital flows. Overall, my takeaway is that this is a very interesting paper and definitely a growing area of interest. I really like the point that these, we should pay attention to the international spillover effects of this. And I gave a few suggestions to sort of sharpen a bit the analysis and the contribution of the paper. But to conclude, a very important topic in the current global economy and geopolitical landscape. Thank you very much.
Thank you, Veronica. Leslie, would you like to take a few minutes to answer?
Well, thanks a lot, Veronica, for the thoughtful discussion. I really like a lot of your points. So let me just respond to a few. Yes, indeed, for the regressions for cross-border and local, I really like your suggestion about pulling regression together. In fact, we have done that. and we do find that there is much stronger response in terms of cross-border relative to local when we pull everything together and add an indicator for the specific mode type in our regressions. And I think showing both set of results helps with that. And what adds to our confidence about these set of results is if we looked into earnings call transcripts of these banks, and there are statements which we cite in our paper are illustrating how banks are really thinking about these decisions and how they're thinking about the segmentation in terms of kind of the cross-border component and local components. For example, you read some of these large global banks after the Russian-Ukraine invasion, and you can see, you know, that they are really explicitly talking about how, you know, a lot of the exposures through their local affiliates may be thought of as kind of an isolated component, and where there are downside losses are kind of sheltered by the deposits or funding they're getting from these fronts. So that adds to our confidence about how we're thinking about these results. And I love your suggestion about the quantification. We actually also, that's going to definitely be incorporated in the next iteration of the table. We also have done that, and that's a very nice suggestion. And one final point I want to clarify is in terms of the Schnabel paper that you point out. So for that paper, they're looking at, using Peruvian credit history data, looking at how US banks are lending to Peruvian banks versus US banks with operations in Peru differently in response to liquidity shocks. So the key thing they're highlighting is kind of following this idea of internal capital markets by Settarelli and Goldberg, and how you kind of, there's more internal capital markets working through within the banking organization in response to these shocks. So that is something I think is a bit distinct from what we're doing. So we looked at the internal capital markets components, and we do not see a significant difference effect in response to geopolitical risk. So less connection between kind of the home and affiliate in response to the geopolitical risk scenario. But thanks for raising that.
Thank you. All right, so I'm going to start here and then.
Thank you. Carolina Villegas, Academia de Negocios. Very interesting paper. I was wondering whether you have information on the borrower side in the target country, in the end country, because there is this all the literature looking at FDI, banking in FDI that would accompany like firms. And I was thinking that maybe you could use that to try to distinguish your like seizing like channel. So whether it's like these subsidiaries, these affiliates like lending to multinationals that now like are going also into trouble because of the geopolitical risk. And if you could distinguish like on the borrower side, like what these affiliates are doing, I think that would be like a nice exercise. Thank you.
Take a second question. Yeah.
Cosette, ECB. Thank you very much. It's a very interesting paper. I have a somewhat technical points on the spillover effects. So banks that are more exposed to geopolitical risk could be providing specialized loans, for example, to support exports. I have in mind, for example, the Paravicini Rappo Potential paper that goes in this direction. But then the effects could come from a differential demand for credit by firms that, for example, export to Russia. And in this case, then, so if the banks that are more exposed provide a specific type of loans, then the effects could actually come from a demand effect. And I have in mind technically a violation of the Kwajalein assumption that firms are indifferent across banks. Maybe you could look at specific loans and check whether there is an effect. And if there is time, I didn't get about the, so you pushed a lot the risk of expropriation, but I wonder whether part of the increase in the risk of borrowers default comes from the effects that were shown by the previous paper by Beata. So, for example, there could be an impact of sanctions, of secondary sanctions, and also reputational risk.
It was technically 3 questions, so.
So I think the first 2 questions I think are related, and we would love to look at the demand side at a more granular level. As Veronica alluded to, we would need kind of a cross-country credit registry in order to get to that dimension of looking at who are the exact borrowers of the US affiliates in these countries. So in one data set where we used to look at cross-border versus local, unfortunately we only have at the more area level. At the Y14, we can see the borrowers, but we cannot distinguish whether it's a subsidiary branch versus a home country. So we're kind of, our hands a bit tied on these fronts. With that being said, I think, no, even with the demand side being front, I think the evidence that we dug into on the various disclosure reports, earnings call transcripts, analysis about how banks are talking about the segmentation of the market and how the local ones are kind of thought of and funded and operated differently relative to the home in response to kind of what they explicitly say, an unexpected turn of events in the Russia case, gave us some confidence there is kind of a supply effect margin happening at the same time. Sorry, the second question, sorry, could you remind me?
Yeah, I was wondering whether the increased risk of borrowers default may be coming also from the impact of sanctions and reputational risk. And that was actually the object of the previous paper.
So I think we control for sanctions in terms of the cross-country relationships in our specifications. And I think now the key aspect we want to emphasize is kind of the differences in funding structures across the cross-border and local components, whereas these funding structures are providing some differences in terms of sheltering effect. There could be expropriation risk, there could be other types of risks, disruption, destruction that could come with geopolitical risk that affects changes.
And we have 2 questions, Arisa and Beata. Oh, 3 questions, sorry.
Hi, Larissa Schäfer again from Frank Wascon ECB. I very much like this paper. I've read it actually already before. And I have sort of 2 interrelated questions. So one is related sort of to the story, also what Veronica alluded to. I think and also Enrico, I think it's very hard to pin down this expropriation channel, because overall, I find the result sort of a positive result maybe for global banking, because typically in the literature you see when there's a shock, foreign banks actually take out their money and lend more domestically, and you find actually the opposite, that somehow they continue to lend in local markets, which could allude to the fact that they're actually following the exporters and continue sort of locally having a local knowledge to lend with the multinationals, which I know you cannot look at. But I was wondering, maybe at least what you could look at is maybe pricing, that it pays off for them to continue to go through this local market, and they sort of risk of taking, sort of cutting lending in US, so it must pay off for them to do that somehow, right? So because I mean, cutting lending in US just because of some small countries, I mean, you know probably which countries there are, is a big thing, right? So, I mean, that must change sort of the profitability of the banks a lot. So it must be profitable to stay there somehow. Thanks.
Beata?
What is geopolitical risk, right? You talk about expropriation, but then you have shown us a spike in the index for Poland. So essentially what you have in mind is Poland being invaded by Russia and expropriation happening. But could you really distinguish it from the energy shock that took place in Europe as a result of the war and affected Poland directly as well as indirectly through its links to the German economy, which went into deep recession? And second, you gave us example of JP Morgan Chase and other US entities being expropriated in Russia, but Raiffeisen Bank has been profitably operating in Russia. So is geopolitical risk a bilateral variable?
And last but not least, Katerina.
I have a very important question. Is it thank you very much for the very interesting presentation. Now, in the recent years, we have learned a lot about how banks react to uncertainty, and I can think of a few very good papers about this. But you showed us that your results do not hold if you look at other type of uncertainty measures or risk measures. And going back to Beata's point, what is that makes the difference here? What is the channel such that makes banks react differently to, for instance, uncertainty shocks or risk shocks in these foreign countries, which also have the potential to increase credit risk for banks? So maybe if you can share some more insights on what are the channels that explain this difference. Thank you.
And in the negative time that we have, please do provide some answer.
I'll be very brief. So I think some of the points are very much related in terms of the ex post effect, and I think that will be interesting to look into. So there is kind of the ex ante thinking about how banks are responding, then the realization in the long run about how things evolve, which they may not fully anticipate from the ex ante perspective, but I think it will be interesting to look at. And I very much like that point. And on the about what is unique about geopolitical risk, so we think of it as, it encompasses some uncertainty risk. For example, some of our components of how we construct geopolitical risk is kind of the uncertainty factors that's come in with geopolitical, but there is also kind of the physical destruction component that could come. So it's kind of some broader uncertainty, but something that's very unique to geopolitical risk as well. And so some of kind of the cases or the examples that I was thinking about in terms of, extreme uncertainty, expropriation risk, asset seizures, repatriation, limits to repatriating profits, are something that are more likely to come in like geopolitical risk disruptions relative to just kind of economic crisis. And that is kind of what motivates to write down our model. So there's something here that's more than kind of just general economic uncertainty, which banks likely is more equipped to manage given their risk management function that's already operating at these banks. And so in terms of Poland, we agree that there is not kind of a expropriation likelihood isn't very high for some of these countries. But there is maybe like second order effects happening to that front in terms of indirect exposures, given that they are some more Russian-related operations in these countries, as well as kind of the softer forms of interventions that I mentioned about some kind of limits to asset repatriation that could happen, which we've seen in cases of past crises. But I'm happy to chat more about that.
Yeah. Not sure about the Russian-related operations there. Okay, thank you very much for this great session, and I think we have a break.